and welcome to Navin Fluorine International Limited Q2 and H1FY22 earnings conference call. As a reminder, this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Radesh Welling, Managing Director of Navin Fluorine International Limited. Thank you, and over to you, Mr. Welling.
Thank you. Good morning and a very warm welcome to all the participants. I'm joined by our CFO, Mr. Ketan Sablok, and Strategic Growth Advisors, our Investor Relations Advisors. I hope everyone got an opportunity to go through our financial results and investor presentation, which has been uploaded on the stock exchange as well as on our company's website. Before I start with my comments on the business performance, I would like to brief you on a few developments at Navin Fluorine. To start with, I'm pleased to inform you the Board of Directors have declared an interim dividend for FY22 of rupees 5 per equity share of a face value of rupees 2, which is about 250% of the face value. We are pleased to inform you all that based on the recommendations of Nominations and Remunerations Committee, the Board of Directors has appointed Ms. Apurva Purohit as an additional director in non-executive and independent capacity on the board of the company with effective yesterday, i.e. 19th October 2021. Her first term of appointment as an independent director shall be for a period of 5 consecutive years. We are very happy to have Ms. Apurva Purohit on the board. The board of directors of Navin Fluorine now comprises of 9 independent directors, 2 executive directors, and 1 non-independent director. The board will now have 2 women independent directors. Her appointment will further strengthen the board and is important for promoting diversity of thought and experience essential in view of the expansion and growth that Navin Fluorine has charted for the coming years. Ms. Purohit is a prominent Indian business leader with over 30 years of experience in the media and entertainment industry. She has been named as one of the most powerful women in business by India Today Group and Fortune India over several years. She also serves on the board of Mindtree Limited, L&T Technology Services Limited, and Manipal Health Enterprises Private Limited. We also wish to inform that based on the recommendations of Nominations and Remunerations Committee and consideration of Board of Directors of the company, Mr. B.K. Bansal has been appointed as Chief Financial Officer of the company with effect from November 1st, 2021. Mr. Ketan Sablok, our current CFO, is leaving the company to pursue other opportunities. To enable orderly transition, Mr. Ketan Sablok has agreed to continue to be part of Navin Fluorine till October 31st, 2021. Mr. B.K. Bansal will be joining Navin Fluorine as CFO with effect from 1st November 2021. He is a chartered accountant and has over 30 years of experience in finance, accounts, IT, and strategy. He is a recipient of various prestigious awards like Most Influential CFO of India and CFO Leadership Award. His last employment was as a CFO and Director of Finance at Balkrishna Industries Limited, where he worked for around 15 years and where under his leadership, the company's market capitalization grew from around 200 crore to more than 25,000 crores. I would also like to place on record my sincere appreciation for the excellent work done by Ketan during his association with the company. Ketan has been a strong pillar and has played an important role in taking Navin to where it has reached today. I would take this opportunity to thank Ketan on behalf of everyone, including the Board of Directors, for his dedication towards Navin. He will be missed. I wish him all the success in his future endeavors. We welcome 2 very high-caliber members to the Navin Fluorine family. The company will immensely benefit from the significant business acumen, extensive experience, and successful track record of Ms. Apurva Purohit and Mr. B.K. Bansal. The appointments come at a pivotal time as we prepare for our next stage of growth and complements team's expertise as we advance our focus on high-value businesses with strong pipeline of new opportunities. Let me now start with key highlights for the quarter and for financial year ended September 2021, followed by business segment-wise updates, and then Ketan will take you through financial highlights for the period. For H1 FY22, the company has delivered operating revenue of 638 crores with a growth of 25% on YOY basis. Operating EBITDA of 162 crores with a growth of 11% on YOY basis, and operating profit before tax of 139 crores with a growth of 11% on year-on-year basis. We witnessed continued growth momentum across businesses with possible exception of refrigerant gas business. The legacy business uptick was driven by improved demand scenario for our inorganic fluoride business, whereas specialty business led the growth for high-value business. On operating margin front, we saw higher employee costs and some of our input costs impacted the performance. Given the high growth journey we have embarked upon, we will continue to invest in and grow some of our critical functions like technology, research and development, business development, etc. And this will continue to reflect in higher employee costs. We believe this investment will help us set very strong foundation for future growth. On new projects, we expect our HPP plant to start from end of Q4 FY22, beginning Q1 FY23, as mentioned earlier, and our MPP plant will come on stream during H1 FY23 as per schedule. We continue to identify, evaluate and develop new opportunities, some of which are now in advanced stage of planning. Our high-value businesses have seen good growth of 21% to 403 crore for H1 FY22 compared to same period last year. It now contributes 63% of the total revenue in H1 FY22. Our specialty business reported a growth of 28% on YOY basis to 254 crore for H1 FY22 compared to the same period last year. Growth here is primarily driven by international sales. During the quarter, we have also initiated price hikes to offset higher input costs. We've launched 2 new products, one in agro and another in specialty materials segment during the quarter, and continue to focus on introducing new products by leveraging our R&D capabilities and deep fluorination expertise. Our CRAMS business has reported a growth of 12% to 149 crore for H1 FY22 compared to same period last year. Just to add some color and context to this performance, last year in 2020, our plant was closed in March and April for 3 weeks due to COVID. CRAMS is typically a long order to delivery cycle business, and this saw a lot of sales getting bunched up and pushed from Q1 to Q2. Due to this, we saw very low sales in Q1 and proportionately high sales in Q2 of last year. As against that, we had very even sales this year between Q1 and Q2. In other words, if you leave aside very high sales number in Q2 last year due to this phenomena, the sales we have achieved in Q2 this year is the highest we have ever done in any quarter till date for CRAMS business. This performance was driven by repeat business from existing customers, which is a testimony to our growing customer relationships and strong execution capabilities. We continue to work on development of new relationships across US and Europe, which will lead to expansion of project pipeline and diversify our customer base further. Legacy business, primarily inorganic fluoride business, has shown positive momentum backed by improved demand. For H1 FY22, revenue has grown by 30% on YOY basis to 235 crore compared to the same period last year. Our inorganic fluoride business grew by 56% on YOY basis for H1 FY22 to 120 crore compared to the same period last year. And for Q2 FY22, it recorded a good growth of 33% to 65 crore compared to the same quarter last year. This segment performance improved due to improved demand in domestic market and good traction seen from the end user industry. This BU witnessed better profitability on back of optimized sales mix between domestic and international market. Our aim is to continue to widen the end user segments along with new customer additions to enable faster future growth. Our ref gas business grew by 11% in H1 FY22 on YOY basis to 114 crores compared to same period last year. And for Q2 FY22, it showed degrowth of 4% to 55 crores. We witnessed a strong volume growth from the domestic market, whereas export sales were impacted due to higher logistics cost. So that's it from my side. I'll now hand over to Ketan to give you brief on the financial performance of the company. Thank you.
Thank you, Rajesh, and a very good morning to all the participants. I wish all of you are in good health. So before I talk about the financial performance, just would like to say a few words. As Rajesh has just spoken, I decided to move on from Navin after a very long inning. Thank you, Rajesh, for your kind words. I would like to thank the management and the board of directors for the opportunity provided to me during my association now of more than 24 years with Navin. I've seen Navin grow from a two-business company years back to becoming one of the largest integrated specialty fluorochemical company in India. Over the years, working at Navin has provided me an opportunity to grow immensely. The journey has been very enriching. It's been a learning experience for me, and I'll fondly remember the time spent at Navin. Would like to wish everyone at Navin the best of luck and continued success in the years to come, and see Navin scale new heights of success. Now I'd like to share the highlights of our financial performance, following which we would be happy to respond to your queries. For H1 FY22 on a standalone basis, the company has reported a net revenue from operations of 638 crores against 512 crores in H1 FY21 with a growth of 25%. Operating EBITDA stood at 162 crores as against 146 crores in H1 FY21, up by 11%. The operating EBITDA margin stood at 25% as against 28% same period last year. The impact on the operating EBITDA margins was due to higher employee cost and some of our input costs becoming higher during this quarter. The operating PBT was up 11%, stood at 139 crores for H1 FY22 as against 125 crores last year. The operating PBT margin was at 22% in H1 FY22. The profit after tax stood at 119 crores for H1 FY22 and the PAT margin was at about 19%. Now coming to the BU-wise performance for H1, our high value business registered a growth of 21% and the legacy business showed a growth of 30%. So across the business segments, we've shown good growth during this first half. In the legacy business, the performance of inorganic fluorides improved substantially as the business registered a revenue growth of 56% to 120 crores. The ref business also showed decent growth of about 11% to 114 crores. Specialty segments grew by 28% to 254 crores, while CRAM segment grew by 12% to 149 crores. Overall, we have a very strong balance sheet with net cash position of more than 450 crores on a consolidated basis. And the prudent use of capital has helped Navin to improve the overall capital employed further to 22%. Coming to the quarterly performance for Q2, the company reported a growth of 5% in net revenue from operations to 324 crores against 308 crores Q2 FY21. The operating EBITDA degrew by about 11% to 84 crores as against 94 crores Q2 FY21. The margins stood at 26% for the quarter FY22. The operating PBT was lower by 13% to 72 crores as against 83 crores in Q2 FY21. The PBT margin stood at 22% for the quarter. PAT at 62 crores for Q2FY22 as against 67 crores in Q2FY21. The PAT margin was at about 19%. Coming to the business-wise performance for the quarter, the high-value business grew by 1%, while legacy business grew by 13%. The specialty segment grew by 19% to 122 crores, while the CRAMS business was lower by 17% at 82 crores. In the legacy business, inorganic fluoride showed an upward trend, growth of about 33% to 65 crores, whereas the ref gas BU registered a degrowth of about 4% to 56 crores in YOY basis. I think that's pretty much from my side. We'll now open the floor for questions and answers. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Abhijit Akella from IIFL Securities. Please go ahead.
Yeah. Good morning, gentlemen. Thank you so much for taking my questions. Just 2 of them. I'll just start with the first one. On the CRAMS business, we've been maintaining this quarterly run rate of about $10 million a quarter revenues. Is there scope for a further step up in this trajectory in the second half, particularly since we were working on debottlenecking the business, and that sort of thing? And second, also just on the refrigerant business, given the news reports about rising prices in China of various refrigerants, is it possible that this business could benefit in the short term from rising realizations?
Yeah, thank you very much. So, as I have mentioned before, if you look at in our CRAMS business, we saw a significant jump last year in FY21. And this year, our primary focus was to ensure that we deliver a steady state $10 million every quarter. Because in the past, if you see what has happened, is that the business has been extremely lumpy. So if we have one spectacular year, it typically follows with one down year. So our focus this year was to ensure that we continue both from the demand generation point of view as well as demand fulfillment point of view, especially on the demand fulfillment point of view, a run rate of $10 million. We believe that in the second half of the year, we might see a small improvement, but not a significant uptick. That is something that we expect to see from the following year onwards. The second question was on the refrigerant gas side. Your observation is absolutely right. We have now started going out in the market and implemented price increases, and we expect in the short term to see some uptick because of the increase in the prices.
Got it. Thank you. And the second thing I had was just on the capex execution. So, if I'm not mistaken, we need to execute somewhere around 650-700 crores for these 2 projects that we are implementing. The 1H capex so far, as far as I can see from the cash flows, is about 170 crores. So, should we expect a big step up in capex in the second half and first half of next year? If you could just help us understand the timing of that capex implementation. Thank you so much.
Abhijit, if you see our consolidated balance sheet, so we already have about more than 300 crores in CWIP. So those are the capexes which are getting implemented. So primarily the project Orchid, which is the primary project that's getting implemented, and MPP is coming along with it. So currently, as Rajesh has already mentioned in his commentary, the projects are on track, and and you'll see these projects getting capitalized as indicated by Rajesh, probably in the Q4 or the H1 of next year.
Got it. Thank you so much, Ketan sir, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Thank you. Good morning for taking my question. Quickly on the employee cost side, we did mention that we are scaling up on technology, R&D and innovation. Can you give some color, what is the bench strength we have today in R&D and what is the bench strength we are looking at? And in that part, where are we in the journey and how much more the cost inflation we can see in the employee cost? The other one is considering that there has been a phenomenal demand uptake for the chemicals. Is this also a result of growing churn and the increases which we are supposed to dole out to the employees? So can you just give us a complete picture on the employee cost from the churn side, from the annual hike increment and on the R&D bench strength, and where are we in the journey? That's my first question.
Yeah, so I think if you look at it from the employee cost, there are 3 points that I mentioned, or 3 categories that I talked about, or 3 functions that I talked about. First one was technology, which is technology and design, T&D function as we call it internally. Second was R&D, and third is business development. If you look at T&D, that function actually did not exist in our company, and we've actually pretty much built that from ground up. And today we have close to about 50 people working in that particular function, and that's absolutely critical function because that is the function which is responsible to take a product from the lab to the plant, including designing and engineering of a new plant. So that is where we've actually invested significantly in bringing in a lot of people, and that is an area that we will continue to grow as we look to identify and grow more opportunities. In R&D, we currently have 3 R&D centers, one in Surat, one in Devas, and one in Manchester. We've actually seen increase in the number both in Devas as well as in Surat. And we are currently also evaluating an option of setting up another R&D facility, probably in Mumbai, just outskirts of Mumbai. So there again, we've actually, the costs have gone up, relatively lesser than in T&D, but going forward, that is an area where it will go up. As far as the business development, again, there are some costs which have gone up in India, but we actually continue to look at opportunities to add and strengthen BD team outside of India, especially in US. And we will be in the second half of the year recruiting at least 2 new BD people in US, specifically for CRAMS as we get ready for the next set of growth for this business. Our aim is that we continue to be very prudent in how we actually handle this while investing in the growth. From next year onwards, as we start seeing the uptick in the revenue, we are expecting that on a run rate basis, though from a quarter to quarter it could be different, but on a run rate basis, we intend to keep our overall employee cost at about 11 to 12% of the total sales. So that's the overall plan. And what was your second question, sorry?
No, I was just checking on the churn side. Have we seen any material increase in the churn given that there is a huge demand for chemical products and there is an expansion announced by all the companies across the segment? Are we seeing increased churn in the employee in our organization?
Yeah, so I think if you look at the overall attrition rate at a company level, we have not seen a significant uptick. But yes, what is important for us is to ensure not to look at it at an average number, but to look at business critical roles and especially high potential people. So there we have actually brought in some retention piece, etc. We've implemented that in the first half. So some of the high employee cost that you see is also because of this retention component which was paid out. The next part will be paid out later the financial year, towards the end of the financial year. So we have implemented retention program specifically for business critical roles, and that is across businesses, across functions, and across levels.
Thanks, Rajesh. That's pretty much clear. Just one additional data point, if you can provide. What is the employee R&D strength today, and what is the targeted we are looking at, say, next 2 years with the Mumbai R&D center also getting commissioned?
So currently we have approximately about 120 people across all the sites, and we are looking to take that number. In the first phase, we will be taking that number to 150 plus, and eventually we intend to take that in the short to medium term to at least 200.
That's fair. That's pretty much clear. Thank you very much. And my second follow-up question, again, slightly bookkeeping kind of a thing. But the other expenses have also increased. Is it predominantly because of the freight, or is there a one-off or anything we should know about?
So, other expenses, yeah, you're right. Freight is one of the components. Plus, we've also, as we had spoken in the last call, we've had this consulting firm who's doing the consultancy for us. So that cost is a significant cost, which is also part of other expenses. So the two primary things that are with the other expenses for H1 has been these two, plus with the uptake in production compared to what was it last year, the overall power fuel consumptions have also the R&M, the repairs, maintenance expenses have also gone up because Q1 of last year was pretty much very low. So probably on an H2H basis, the primary components have been the power and fuel, the maintenance expenses, the freight charges, and the legal and professional, where we have booked in the consultancy charges.
Fair enough. That consultancy should be going off, right? That's not a recurring one. How much it would be?
So for H1, it was about 5 CR, and you're right. This is the one of this one, which will not be. It will be, some of it will be there in the next quarter, but post that it won't be there.
Got it. Thanks. One last question on the business side. On the margin front, we did mention that we are taking a tariff, some price hike. Considering that we are still at the same margin where we were earlier, we haven't seen any pressure from the raw material, at least on the margin in the Q2 number. I understand that the price hike started happening on the later half of Q2. But we should be able to maintain or improve from here, right? Because ref gas prices are going up, but ref gas raw material prices are not going up. To that extent, we should see improvement of margin from these levels. Will that be a fair understanding?
Yeah, I think that would be a fair assumption. Our efforts are to ensure that we at least maintain the margin or move the margins up.
Got it. Thanks for all the answers, and best of luck for the Ketan for his future endeavors.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. The first question, on the senior management churn that we have been seeing. So all the replacements have been largely done, or there are still certain pending groups which we need to cover up?
Yeah. So on this particular piece, and I know that this probably question will be there in mind of other people as well. So I think this churn that you are actually looking at is primarily driven by 3 reasons. One, in some of the businesses we have done some kind of a business reorg, because of which some of these roles have actually become redundant. So those will not be replaced. For example, you talked about COO of CRAMS business, so it will not be replaced. Some of these have actually been prompted by company, and some of these have been driven by individual decisions. As I mentioned in my opening speech, decision related to Ketan's departure, it was his decision. He clearly will be missed because he's been an integral part of the family, and I'm sure he will continue to be part of Navin Fluorine family. But some of these, like for example, HR, we already have a new person on board who's joined about a month back. He comes from RPG Enterprises and having worked in Dr. Reddy's for many years, both in India as well as outside of India. And as far as the CFO position, as we mentioned earlier, the new person will be joining from 1st of November. So all the critical positions that we want to be filled have been filled up.
Sure, sir. That's helpful. And from an R&D investment perspective, you did mention, a new center coming up as well as the increasing manpower, as well as the business development on the CRAMS side. Correct me if I'm wrong, because, earlier in the quarter, we did mention some bit of debottlenecking-led initiatives in CRAMS business, which can drive the near-term growth. But from a fresh capacity, CGMP4 or a new CAPEX, are we on time for that? Because, if on one side we are trying to scale up the CRAMS business, the capacity may not be in shape as much. So just your thoughts, both on, especially on the CRAMS side.
Yeah, so there are two pieces. So one is that the assumption, the statement that you made on the R&D lab in Mumbai, so that is currently being planned. It is not currently ongoing. It's not something that is currently happening. It's something that we are planning, and that's not related to CRAMS business. That will be related to specialty business and some other opportunities that we are working on in some other parts of the business. That's not specifically related to CRAM, and that's currently we are looking at multiple options. Mumbai is one of the options that we are considering. As far as the capacity piece is concerned, as I mentioned in my earlier commentary, our first step would be to debottleneck our CGMP3. Then we would be looking at CAPEX for CGMP4. So as far as the debottlenecking of our existing CGMP3 is something that we are currently developing a detailed business case for that. And we are hoping that is something that we will go to the board, get an approval for, and that will be implemented in the next financial year. Thereafter, by end of this financial year, beginning of next financial year is when we will actually start working on the CGMP4 business case. So that is how we are actually looking at it. Phase 1, which will come into play next year, will be debottlenecking of CGMP3, for which we are currently working on the plan. And CGMP4, the work will start post approval for CGMP3 debottlenecking, which will happen. The work will start from end of this financial year, beginning of next financial year.
Sure, sir. That's helpful. And lastly, on the margins front, you referred to, the same question earlier as well. So if I exclude the consultancy charges, which will go away probably Q4 onwards, and the power fuel cost, which either will pass through over the next maybe a quarter or so, or it will be, eventually being borne by the customer. And despite these elevated costs, our margins are still, the gross margins are still largely stable year on year. So are we seeing a structural sort of, uptick in these margins going ahead, maybe 2-3 years down the line?
We would like to believe, because if you actually look at all the new business opportunities that we are working on, either on HPP side or some of these other opportunities, our efforts always are to identify and develop opportunities which will help us gradually move these margins up. So if you look at it from the 2 to 3 year perspective, yes, that is clearly our effort, and that is actually reflected in all the new opportunities that we are identifying and developing.
Okay, sir. Great. Thanks a lot, and all the best. Thank you.
Thank you. The next question is from the line of Tejas Seth from Nippon India Mutual Fund. Please go ahead.
Hi. Good morning. 2 questions. One, on the CRAM side, you did mention that there's a good repeat business from the existing clients. Now, this repeat business, is it for the existing molecules, or we have added new molecules from them?
So it's a combination of both. Specifically, if you look at this particular period, which is H1, and the numbers therein, that is primarily coming from a repeat business on the same molecules as those molecules are scaling up. Having said that, with some of these customers, we are actually seeing number of new opportunities or inquiries that or opportunities that we are identifying and developing. But those, as you can imagine, are at an initial stage, and hence it is not making material impact on the number. But if you look at purely from the opportunity perspective, yes, we are actually seeing more opportunities come from the existing customers. But in terms of numbers, it's primarily driven by the repeat business of the same molecules.
Okay. And any molecule, okay, I think you wouldn't be known, but is there any idea that any of the molecules has moved to a higher phase, maybe phase 3 trials and all?
Yeah, so as we had indicated, we have one additional new molecule which is actually moving into phase 3 next year. And some of these molecules are actually moving to the kind of a late stage phase 2, for which they need slightly higher volume. Some of it we actually delivered in Q2.
Okay. On the second question, I would want your view on the sustainability of ref gas prices, and does this entice us to add products to our portfolio where we don't have presence, that is R32 and R134A. I think in past we had given a thought towards that. Does these price increase or realizations increase entice us to add those capacities?
So as far as the price increase is concerned, lot of that price increase is driven by the increase in the input costs. And some of these we are actually implementing going forward. We'll be implementing in our existing products, which is primarily R22. As I mentioned, we are working on portfolio of new products in the ref gas side, and that decision, the decision to invest or not in those products are going to be driven by the long-term sustainability, long-term economics or prospects of those products rather than the short-term spike in the prices. So that is something that we continue to work on, and as I mentioned earlier, we should be able to reach the decision on this by end of this financial year.
Okay. Thank you for answering the questions.
Thank you. The next question is from the line of Manoj Garg from White Oak Capital Management. Please go ahead.
Yeah, thanks, and good morning to Rajesh. So, Rajesh, I think in our prior interactions, you had alluded that we are working in a couple of new areas outside spec chem, CRAMS or HPP. Is there any progress on that account which you feel is worth sharing at this point of time?
No, not really. In fact, as I have actually commented earlier, these are typically long-term opportunities that we are incubating, and it will take us at least about 2 to 3 years for these to really take shape and then form a separate business vertical of its own. So these are typically opportunities. These are not opportunities like the ones that we currently have been working on. These typically take a longer time for qualification, for development and qualification. But once you are in for decades. So as I have mentioned before, it will basically take us approximately at least about 2 to 3 years to get to a level where it will actually start making material impact on the numbers and will warrant consideration of setting up a new BU under which we put these opportunities.
Got it. And second, in the past, we were also of the view that as some of our customers may see the ramp up in the products or the molecules for which we are exclusive suppliers, we may think about putting up the dedicated plant under CRAMS business vertical. So anything again, Rajesh, where you are seeing traction, and how do you see how far we are from that stage?
Yeah, so there is a discussion going on with some of them. As you can imagine in CRAMS, versus let's say specialty or in agro, where the volumes are typically multi-hundred ton level. In pharma, typically the peak volume typically tends to be tens of metric ton. So when you talk about dedicated plant, it typically needs a MPP kind of a configuration which is dedicated for a particular customer. So we've actually started this discussion with one particular customer where we are actually currently having number of molecules that we are working on with that particular customer. So we have started discussion with that customer of possibility of setting up a dedicated plant for that customer where we can actually put these multiple molecules that we are working for them. But nothing concrete at this stage.
Great. And just the last question from my side. Again, like Rajesh, you alluded that the endeavor over the next 2-3 years is clearly to move up the value chain and hence improving profitability at the gross margin level. You also, I think, responded saying that while currently the employee cost seems to be at an elevated level, but with next year, revenue, seeing income revenue coming in from the new project and all, probably we are likely to have employee costs in the range of around 11.5%. So is it fair to assume that maybe from a 2 to 3 years perspective, we should start seeing a significant step up in terms of the margins versus where we are today?
No, so I'm not sure what you mean by significant, but as I mentioned earlier, our efforts are always to ensure that we continue to move up the margin curve. And that is also reflected in the kind of opportunities that we go after. So our focus is on selection of the right kind of opportunities, and we believe that if we continue to do that, and if we execute well, the margin improvement will follow. It will be an outcome of the quality of opportunities that we go after and the quality of execution we have in the business.
Sure. Thanks. That's very helpful. Thank you very much for answering all the questions. And Ketan, wish you very best in your new endeavor. Take care. Thank you very much.
Thank you, Manoj.
Thank you. The next question is from the line of Ritesh Gupta from Kotak Securities. Please go ahead.
Hi, sir. Thanks so much for taking my question. Just one on the specialty chemical business. I mean, you did say about new projects, etc. as well. I mean, so is there a chance that you may have to announce another opportunity on the MPP, another MPP eventually in, let's say, next 6 to 12 months basis, the pipeline that you see today?
So I think the only thing I can say at this point in time is that we are working on a few opportunities. How many of those actually get converted into actual investments? It's tough to say, but we are working currently on multiple opportunities. As I mentioned in my opening comment, some of these are at advanced stage right now where we are actually doing the capex, etc. Once we complete the entire capex work is when we will our efforts will be to ensure that we convert this particular opportunities into specific multi-year agreements with the customer. Once that happens, we take it to the board for approval, and as soon as that happens, we'll make the announcement. But yes, we are working on a few opportunities. Some of these are at advanced stage currently.
Got it. So basically, when I look at your next 6 to 12 months and I look at the aggregate capex plan, so let's say you have to take a decision on refrigerants by the end of, let's say, this year. Then you have CGMP3 debottlenecking, which I think is already approved and probably you're going ahead with it. Is the correct understanding? That's one question. And then, you probably will take a call on CGMP4 by end of this year or probably next year. Probably next year you will take a call on CGMP4. And then on a MPP, the next MPP for agro again, you will be in a situation to take a call on that only towards the second half of 2023, FY23, right? That's a correct understanding?
So on the refrigerant gas, your understanding is correct. In specialty, we are actually looking at different kinds of opportunities. We are looking at some opportunities which will require for us to set up independent, dedicated plants. Some of these are, in form of MPP. As I had mentioned earlier, when we presented the business case for MPP 1, we have a possibility of setting up another line there by which we can expand the capacity of MPP 1. So that, so rather than actually looking at MPP 2, we would probably be looking at that as a first step. But there are some opportunities that we are looking at which will probably require a dedicated facility within specialty. And then in CRAMS, what I mentioned was on CGMP3 debottlenecking is something that we are currently working on finalizing the capex for that. The capex is not approved yet. And that, because it's just a debottlenecking project, that capex, that execution should not take too long. And CGMP4, once this capex, we take it to the board, get it approved. Post that, we will actually start working on the capex for CGMP4. So our internal estimate is that we will actually start working on that by end of this financial year.
Understood. And I got confused a bit. I mean, you said that once this MPP gets commissioned, then you will take a call on the new opportunities, because the new MPP itself will be able to take care at least for the initial few quantities. And then as you are able to produce well, and as let's say customer gets more comfort, you will probably take call on the future capexes after that. Is that the correct understanding? Or even without MPP1 getting commissioned and let's say running at full force, you may let's say look at few capexes even before that?
So there are multiple things here, Ritesh. One, the point that you mentioned is absolutely right, but that is in context of the products which are planned in that MPP.
Okay.
So there are, as I mentioned before, there are 5 products that we have planned in this MPP. The initial stage will be actually done in this MPP, and we expect at least few of those products to scale up. And as they scale up, some of these will require a dedicated facility. So that investment obviously will happen. That decision will obviously be taken once we commission this MPP, run the MPP for a while, and then these opportunities scale up and merit a dedicated facility. So that's point number 1. Point number 2, as we look to identify and develop more opportunities which will require MPP-like investment, the immediate opportunity that we have is to just expand MPP1 and basically set up additional line there, because we have approximately about 80 bays available for expansion there. So that's point number 2. And point number 3, which is a completely different point, is we are actually looking within the specialty business at other opportunities which will require investment in dedicated facility for a specific product, for a specific customer. There, it doesn't necessarily have to depend on the timeline for commissioning of MPP1.
Got it, sir. That's crystal clear. And just on the demand side, how have you been seeing the demand, let's say from the agro side, especially, there have been some concerns at least that agro demand may start to see some slowdown. I know it says it's only 40% of your overall specialty chemical business, but any sense that you have been getting from your customers? And when you look at new projects, are these like outsourcing projects which are, let's say, coming in from Europe, or these are like new molecules that are coming in, or these are China plus one? So if you could just try to bucket some of these opportunities that you're seeing there.
So I'm not going to comment on the inquiries that we are getting, because inquiries actually, are coming in various shapes, forms, and there is a very strong inquiry flow. But let me talk about more on the opportunities that we are actually going after. A lot of those opportunities are for newer products on the agro side. When we talk about newer products, unlike in CRAMS business, the newer products also have a multi-100-ton to start with, and it quickly moves into a multi-ton level and quickly graduates to a 100 kind of a ton level opportunity. But a lot of these are early stage opportunities. When I talk about early stage, these are molecules which are under patent and just being launched by the customer, and where they are actually just still in the process of getting registration for newer geographies. So they would have got it for one geography, launched it in one geography, and looking for registration to get approved in other geographies. Molecules which are still under patent, and typically they would only have either we are the first supplier, or they would have only one supplier, and typically in the Western Hemisphere. So we typically would be the first supplier outside of Western Hemisphere. Most of the opportunities that we are seeing in agro fall under that particular category.
Got it, sir. That's it from my side, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Sir, my question is regarding the number of customers that we have added in the first half, and what is the concentration of the top 5 customers that we are having in our entire portfolio?
You're talking about across businesses or in any
across
specific?
businesses.
Sorry?
Across businesses, sir.
Across the businesses, I don't think we have a significant concentration, because as you can imagine, all the businesses actually serve completely different segments. CRAMS is primarily innovator pharma companies. Specialty is primarily agro and industrial. Inorganic is primarily large stainless steel glass companies, and again mostly in India. Refrigerant is basically the OEMs and the trade market, again primarily India and then some in Middle East. So the segments are very, very different. So because of that, we don't have much customer concentration. The largest customer we have would probably have a revenue of about 12 to 15%. That's about it. The remaining ones, we don't have many customers who constitute more than 10% of our total sales. Most of the customers are actually below 10%, so there is no concentration there. As far as new addition of the customers, again, we look at that number business-wise, because in some of the businesses like inorganic, typically the new customer addition is relatively small because we continue to serve existing customers. And the new segment that we try to develop in inorganic, there again there is a relative customer concentration. So in refrigerant gas as well as inorganic, that is not of material. In specialty, we've actually developed 2 new customers for our industrial segment, and both of these are international customers. In agro, we basically, any which way the market is very concentrated as far as agro is concerned, so we continue to serve the same customers, just expand our reach into the same customers. On the CRAM side, we have actually added a lot of new relationships. Most of these are to smaller biopharma companies in US, and there is one relatively large pharma company in Europe.
So, is the shift towards manufacturing in India or outsourcing to India also part of the constant change in socio-economic conditions in Europe, where the industrialization and manufacturing there is continuously going down, and the people there are much lesser interested in actually manufacturing things, and particularly which are not environmentally friendly. Do you see that as a constant change which will drive outsourcing to our company?
So you're talking about moving the manufacturing from Western Hemisphere to India. Is that what your question is?
Yes.
Yeah, in the kind of business that we have, that's not the case. Okay, because we typically look at, relatively speaking, these are, higher margin, lower volume kind of opportunities. We are not looking at commodity chemicals, etc. And in a lot of these, if you look at the environment standards, etc., we have much more stringent requirements and standards in India than in some of the European companies. So, we've already significantly higher in terms of standards than, let's say, in countries like even UK or Italy, etc. In terms of the business that we have, or the business profile, or the focus that we trying to drive in the business, at least in some of the businesses like specialty. We are actually taking some of this business from some of the companies in Western Hemisphere, because as I said earlier, typically in agro, India used to be a number 3 or a number 4 supplier. The first will be in Western Hemisphere, second would be, let's say, in China, and the third one would be in India. Now we are actually moving up that chain, and we've actually now competing with Europe to become the first supplier for some of these agro opportunities. But no, we are not really seeing any significant shift, especially for the kind of business that we have from Europe to India.
Sir, thank you so much for explaining things so well.
Thank you. The next question is from the line of Naushad Chaudhary from Systematics Group. Please go ahead.
Hi, thanks for the opportunity. A couple of quick questions, sir. Firstly, just wanted to understand, you mentioned we have launched 2 products in this quarter. So, 2 quick question on that. Are these are we first or second supplier of this product, or third or fourth supplier? And what could be the revenue potential if you can quantify? So this is my first question, sir.
Yeah, so I wouldn't really like to talk about the revenue potential because that will depend on how quickly this molecule scale up. But I can add some more color to it. One of them is in the agro sector, where we have actually just made the first commercial supply from our existing plant in Surat. This is where we are not the first supplier. Currently, there is another supplier who's already supplying to this particular customer. And here, the commercial supply of this molecule will continue for the rest of the year. And this is what we had actually done a debottlenecking project for in Surat last year. If you remember, I had made that comment last year. The second one is in the specialty material segment. So this actually goes into completely new application, and that is where we have actually supplied product from pilot for initial qualification. So we earlier supplied material from R&D, and we got approval, and the customer came back to us for supplying product from the scale up. So this is basically at a kg level. So there we've actually supplied the product at a kg level from our pilot plant, and we are in discussion with the customer on initially supplying at tens of ton level from our existing facility in Surat next year, and thereafter possibly setting up a dedicated plant for this. But the second one is where we are the first supplier. This was primarily done by the customer themselves earlier at a very, very small R&D level. And then we optimized the process, and we actually also made a lot of changes to that process. Because of which the customer was very happy, and then they asked us to do the piloting for this. For that, we are the first supplier. And this is, as I mentioned earlier, this is going into a completely new segment.
Perfect. Understood, sir. Secondly, on the balance sheet side, sir, if I look at our overall working capital days, especially on the data days, it has gone down. So I was just wondering, is it because of the product mix, or are we taking some serious steps to improve it, or should it be maintained going forward?
No, our efforts will be to actually maintain this, because there are some specific efforts that we have undertaken in the business on the execution side to ensure that there is clear focus on bringing these NODs down. So that we are, at least our efforts will be to ensure that we sustain this.
Okay. Any number or target you have in mind to bring it to certain level?
So we don't really have exact numbers as a target, but we try to optimize the overall receivables and just tend to ensure that the receivables are good. And the efforts, as Rajesh said, we are taking with the business to ensure that the entire receivables basket is under control.
Perfect.
We have a budget number which is different for different BUs, but that's basically meant more for our internal consumption.
Understood, sir. Lastly, just to check in terms of our capital deployment to our CRAMS and SpecChem business, as per my understanding and record, we have spent so far around 200 crore rupees, which we have capitalized on CRAMS, and a similar figure for SpecChem. Are these numbers are correct, or if you can share how much we have spent in both the division?
You're talking about what we are planning or what we have already done?
What we have already done, yeah.
Yeah, so we did that CRAMS CGMP3 project 1.5 years back, so that was about 120 crores, and then we've done some debottlenecking projects in the specialty side. So yeah, these are the two large spends we've done over the last 2 years. The balance is all coming up currently. The 200 crore specialty which you are talking about is the one which we are scaling up at the MPP at Dahej.
I was just trying to understand how much so far we have spent. So CRAMS broadly would have been around 200 crore rupees. Are these figures correct, sir?
No, these figures, total CRAMS is higher than this 200 crores.
Okay. And in terms of revenue potential, should we just multiply it by 2.5x of asset turnover, or is there something else to read it?
No, that's what we have said, that the asset turn in the CRAMS will be about 2 to 2.3 times the investment.
Okay, that's it for now. Thank you so much, sir.
Thank you. The next question is from the line of Amar Maurya from Alpha Accurate Advisors. Go ahead.
So thanks a lot for the opportunity. Good morning, Rajesh sir, and Ketan sir, best of luck for your future endeavor. Sir, about the specialty chemical business, we indicated last time that there was some issues with the inventory pile up in our customer and at a pharma business. So those issues are behind now?
Yeah, so that commentary was specifically related to one product which actually the end market is ARVs, and this product is actually primarily this goes into unregulated market, in Africa, etc. And it's primarily financed by this Bill Clinton and this Gates Foundation, etc. And because a lot of those funds have been diverted to providing COVID vaccines, there's no funding available right now for this. We expect that issue to actually continue at least for the rest of this financial year. For our internal calculation, we are assuming that we will actually not see any business from that this financial year, and we've already started looking at opportunities to remap those assets.
Okay. And secondly, sir, the RM inflation, which we had seen last quarter in the specialty chemical business, and we were looking to pass on those prices. So, are those price pass-ons are done, and that is what is reflecting in the margin?
Yeah, so some of it is done. Some of it is actually going to be done from January of next year, because that is what the customer requested us for, because even the customer had a back-to-back order. And this is a large US customer for us in industrial segment. So some of it has happened. Some of it will actually happen, from January onwards.
So basically, there is a further, scope for margin improvement, at least from this side.
Yeah, assuming the costs don't further again go up.
Yeah, that is true. And sir, thirdly, on the CRAMS business, this current run rate of 82 crore is like a kind of a peak run rate for the current facility till the time the debottlenecking doesn't happen?
No. So currently, from the execution point of view, as I mentioned, our focus is to ensure that we do a run rate of $10 million every quarter plus minus. That's our immediate focus for this year. And then we will actually start seeing uptick from the next financial year onwards. We have some headroom from the capacity point of view. But again, when you talk about capacity, there are a number of other variables like, what are the exact processes that, what are the exact unit operations that those products require, what is the capacity required in the high pressure fluorination side, hydrogenation side, etc. But overall, yes, there is headroom available even at about 82 crore level.
Okay.
But currently, from overall execution point of view, our immediate focus at least is to ensure that we maintain this $10 million run rate, 10 million plus minus every quarter.
Okay. Okay. Thank you, sir. Thanks a lot.
Thank you. The next question is from the line of Rishit Shah from Danki Securities. Please go ahead.
Yeah, hello sir, good morning. So just one bookkeeping related
Rishit,
question.
sorry to interrupt you, you're not audible.
Yeah, can you hear me now?
Slightly better, go ahead.
Yeah. So just one bookkeeping related question. So in the consolidated balance sheet, if we see, so there is a 100 crore odd increase in the other financial liabilities in the current liability side. So can you just elaborate what particularly that is?
You're talking about what?
Yeah, first half, yes.
No, I think you're talking about which? Just a minute. You're talking about the borrowings part in the other financial liabilities?
Yeah, so in the current liabilities, under the head other financial liabilities, so it has gone up from around 31 crore as on March to 136 crore as on September. In the consolidated balance sheet.
So in the consolidated balance sheet, that increase is because of the increase in capital creditors in NFASL. Let me check that and I'll get back to you on the details. I don't exactly have that breakup in front of me, but let me check that and I'll get back to you.
Sure, sir. No issues. Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, that will be the last question for today. I will now hand the conference over to Mr. Ketan Sablok for closing comments.
Yeah, this is Radesh Velling. I would like to thank everyone for joining on the call. I hope we have been able to respond to your queries adequately. For any further information, request you to get in touch with SGA, our investor relations advisors. Please take care and stay safe, and best wishes for the festive season. Thank you very much.
Thank you very much. On behalf of Navin Fluorine International Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.